Okay, good afternoon. Today is the 17th of July, 2021, and today we'll be discussing on an interesting topic, even though it's an interim or a temporary standard that takes care of one or two activities within a specialized industry where mineral resources is being extracted. Now, this is IFRS 6, talking about the exploration for and evaluation of mineral resources. Okay, and we need to understand one thing here. This standard is more or less going to be dealing with entities that find themselves in the preliminary stage prior to development of mineral resources from its activities as an entity. Okay, and we'll be looking at organizations or entities like those involved in oil and gas exploration, look at entities involved in mining of coals, gold, and some other related activities. Okay, now let's look at the reason why IFRS 6 is introduced, even though we'll discuss much more on the objective and the scope as time goes on. Now, IFRS 6 was introduced as an interim standard, as I've said earlier. It's a temporary standard that takes care of the short-term solution towards a problem relating to accounting for companies that are involved in exploration and evaluation activities involving mineral resources. Okay, IFRS 6 was implemented for accounting period beginning on the 1st of January 2006. And currently there have been no plans to develop or replace the standard. Okay, but again, we need to take note of one thing. Now, this standard tends not to more or less take care of accounting for mineral resources beyond development stage. That means from the development stage to the production stage, this standard does not apply. We must take note of that. But this standard only applies prior to developmental phase of such an activity in mineral resources. Okay. Now, before IFRS 6, what we found out is that there have been various accounting practices that vary from time to time among different standard setting bodies across the globe, including practices used by various companies affected by similar transactions. And it was important for the IASB to put up a standard that could standardize the processes and make comparison more effective, and the information contained in financial statements of such an entity more reliable. Okay, since it has been specifically excluded from all of this accounting we're going to discuss with respect to evaluation and exploration of assets, of mineral resources, are totally excluded from the requirements of IAS 16, IAS 38, and any other standard as the case may be. Okay, and we're going to ask ourselves, what does it constitute an exploration and evaluation activities within such a venture where we involve ourselves in mineral resource extraction as an industry or as a business. Okay, but let's quickly look at what the objective of IFRS tends to address. I'll itemize it. Okay, now IFRS 6 tends to address the following. The first one is that it provides a limited improvement to existing accounting practice for exploration and evaluation expenditures, okay? And also it allows entity to recognize exploration and evaluation assets so that they are recognized in accordance with the standard in such a way that standardize the processes and also give room for the impairment recognition in line with the requirement of IAS 36. Okay, so that such an asset that is considered exploration and evaluation asset will equally be subjected to impairment assessment in line with IAS 36 as it affects other assets. Finally, the standard tends to provide us objective essence of disclosure regarding the identity and the amount involved within the financial statement of an entity that is involved in exploration and evaluation of mineral resources, so that it helps users of financial reports to understand the amount, the timing, and the certainty of cash flows incidental to such exploration and evaluation activities. Okay, And what could easily come to mind when we discuss this standard is oil and gas accounting. But it will be word of note to say that this does not necessarily address the entirety of oil and gas accounting. It only addresses the aspect of oil and gas accounting at the preliminary level between the period of acquisition right and the period of exploration right. It stops at that point, and it does not address transactions that involve developmental right or production right. Okay, as we are going to see later on, that there are 4 phases within oil and gas activities, and those 4 phases constitute what we call the oil and gas cost, as the case may be. And we're going to see that as time goes on. Furthermore, we'll look at the scope of the standard. Okay, what does IFRS 6 addresses and what does it not address? These are the key things we need to take note of. Now, the first one is that an entity shall apply IFRS 6 to exploration and evaluation expenditure that it has incurred. Okay, later we're going to look at what constitutes exploration and evaluation expenditure. How does this differ from exploration and evaluation assets and some other things like that? The second thing within the scope is that the standard does not address other aspects of accounting by entities involved in exploration for and evaluation of mineral resources, especially when you have more or less reached a developmental phase and up to the level of production. Okay, in conclusion also, we find out that an entity shall not apply this standard to expenditure incurred before the exploration for and evaluation of mineral resources. Such expenditure incurred before the entity has obtained the legal right to explore a specific area. Okay, we are going to discuss all of this. And also, it does not apply to expenditure incurred after technical feasibility and commercial viability, extracting of mineral resources are demonstrable. Okay, but we're going to see that later, which means what we are trying to say is that before you obtain a legal right towards the mineral resources, why we're emphasizing on legal right? Because mineral resources belongs to the state, to the government. Therefore, for you to have access to it, you must first of all have a legal right. Okay, any cost incurred prior to obtaining a legal right does not fall under the recognition of this standard. The question then is, how do we recognize such a cost? We'll get there. The second one is that after legal right, every cost incurred in the process of exploration for and evaluation of mineral resources will be accounted for under IFRS 6. But such will no longer be accounted for once we get to the developmental phase. And the developmental phase is a phase that more or less has taken care of the technical feasibility of such an exploration and the commercial viabilities of such a development. What that means that developmental phase up to the production phase or mining phase, as the case may be, will also not fall under this standard. But therefore, how do we account for such? All of these are what we are going to discuss in the course of this session. Now, I'll put it to us now to give us 1 or 2 objectives or commentaries on our expectation from this section on evaluation, on exploration for and evaluation of mineral resources and its accounting with respect to IFRS 6. Over to you guys. I want to hear our expectations. I can't hear you guys.
Expectations for IFRS 6. But does it, from what you've said, I'm beginning to see that won't there be a kind of overlap in this IFRS and the petroleum profit tax, which is the basis of accounting and
petroleum profit tax? There's no tax. This is not tax. Accounting and tax are totally different things. Or are you
Oh,
talking of
sorry,
oil
sorry,
and gas
sorry.
accounting as the case may be?
Oil and gas accounting, sorry. Oil and gas as the whole. So this one is just a subset. So I just don't know. If we learn the subset of this one, then we need to learn the total oil and gas accounting basically. Does it really, are we not, is it not supposed to address the whole thing so that one will have a total understanding of it from A to Z than just holding the subset of it? Because that is in this exploration and evaluation, I don't think it contains more of the activities don't actually take place here. The activities are actually more in the production and other aspects and marketing and other aspects of it. So
Okay.
that's just my take anyway.
Okay, one thing you need to understand is very simple. Okay, that IFRS is not industry-based, it's transaction-based. Okay, for example, there are various standards that applies to every company. And therefore, in that regard, we need to have better understanding of how individual transactions are accounted for, regardless of whether it belongs to this sector, industry, or otherwise. And therefore, you must take note of that. Now, oil and gas accounting is elaborate and is made up of various aspects of accounting that is considered together. For example, oil and gas accounting borrows its leave from IFRS 6 first, because that is the first level of accounting in an oil and gas business, similar to mining business, coal business, and some other businesses that involve or entails mineral resources. Therefore, we must not limit our scope in that. Secondly, oil and gas accounting also borrows its leave from revenue recognition from IFRS 15, borrows its leave from IAS 16, from IAS 38, from IAS 36, etc. The only aspect which IFRS has not addressed with respect to oil and gas accounting is the aspect that involves the developmental and the production stage. And that stage only borders on issue of the two methodologies that are available in oil and gas accounting with respect to successful effort method and the full cost method. That is the only aspect. And again, we'll get to understand that IFRS has also provided guidance for you under IAS 8. If you have watched the video, which I've made available to you guys on accounting policy formulations, how do you formulate accounting policies, how do you address changes in accounting policies, changes in estimates, and correction of errors. You also watch that within the relevant paragraph, the standard also makes us to know that there are guidance that are given to us to which management judgment comes to play when there is a particular transaction or set of transactions to which an IFRS has not specifically addressed. And therefore, what do you do in that regard? Okay, and that is why you see that most times the companies in oil and gas devote to using standards that is synonymous or share similar framework with IFRS for oil and gas accounting or other aspects when you get to developmental phase and production phase. And that is why you see that the leave we borrow is from the US GAAP with respect to successful effort method for the production accounting and the what we call the full cost methodology. Therefore, you must understand that issue of successful effort method, full cost method only account for very, probably I would say only account for very little aspect of oil and gas accounting, because that is just at the point of development and production. Okay, how you recognize or capitalize your cost, either as through the use of successful effort method or through the use of full cost method. And what are the costs that are essential in terms of whether a successful effort methodology you adopt or full cost methodology are issues that borders on exploration and evaluation assets, which shows that this is very critical to even understanding or making use of any of those two methodologies. Does that make sense to you now? Enaro.
Yes, I said I'm with you. I understand you, yes.
Yeah. Okay, that's it. Okay, now let's move on. Now, I discussed something earlier Okay, and let's look at it from this perspective. You know, we're discussing the scope. Now, I'll try to use this diagram to explain the scope. Now, we have the phase before obtaining the legal rights. Now we have the phase when the legal rights has been obtained. We have the phase of development and public production. Therefore, the question is this. The phase before legal right means you might have been incurring activities to seek legal rights, to do some studies, some due diligence, some research, prior to you getting more or less like government to grant you a prospecting license. Okay. Now, in that phase, any expense you have incurred or cost you have incurred in that manner is outside the scope of IFRS. Okay. It's outside the scope of IFRS 6. And where is this scope within? You'll find out that most of such costs, if you check standard one by one, they barely fall under any of those standards, or because it implies that such costs ultimately should be expensed as incurred. Whereas all of the costs here between when legal right was obtained and prior to developmental phase, they fall under IFRS 6, and they should be treated as exploration and evaluation assets. And it will be shown as separate assets in your books. And that's where IFRS 6 applies. Now, thereafter, those costs, depending on your use of successful effort method or full cost methodology and co, which are outside the scope of IFRS, this developmental and production phase, these exploration costs will now have to be accounted for majorly under IAS 38 for the aspect of intangibles. Why? For the aspect of tangibles will be accounted for under IFRS 16. 38 for intangibles, and you all know what intangible is from our past learning, and these are for tangibles. Okay, which means IFRS is in between when legal right is obtained, but before development and production phase. And that is that. Any question on that? Any question on that? Now let me give a clue about developmental phase and production phase. Okay, now before that cue, let me identify that there are 4 cost structures in oil and gas, most essentially in mineral resources extraction industry. But let us limit our discussion to oil and gas. The first one is the acquisition cost. Which is synonymous much more to obtaining legal rights. The second one is the exploration cost, which is where you do things like geophysics, surveys, seismic surveys, etc., which is to more or less have idea of whether it is feasible, at least. The other one is the developmental cost. Development costs. This is.
Can I see your screen?
Okay, you can't see my screen, sorry. Okay, development costs. That is the point where you start to incur massive costs on tangible drilling, such as development wells, rigs, platforms, etc. But at the exploration point, that's where you have what we call exploratory wells, just to identify whether there are oil at least there before you start to venture into development where you want to see it in commercial quantity and extract it from the surface of the earth. Okay, and the last one is the production cost. That is when you have more or less gotten to the level of extraction of mineral resources in commercial quantity from the earth crust. Which is called hydrocarbon activities. Okay. Let's reflect on this for 1 or 2 minutes.
I can't hear you, sir.
Okay, sorry. I said IFRS 6 addresses only the first two, acquisition costs and exploration costs. Okay, that is what constitutes our exploration and evaluation expenditure, okay, which will be recognized as the value or cost of the exploration and evaluation assets. The last two costs, development costs and production costs, are usually influenced by the two accounting methodologies, which I said are successful effort method and full cost method. These are totally outside the scope of IFRS 6. Now, the word successful, what it means is this. Let us assume the right we have for exploration provide us to have different wells, okay, exploratory wells. Now, eventually we have within the map we have, let me say, 7 exploratory wells, okay? Now, what we discovered is that of these 7, the only one that proved successful that has oil is just this 5. Oil denotes those black dots. But these 2 has nothing, empty. Now, the question then is, the expenditure we have recognized under IFRS 6, what are the expenditure? Acquisition costs, not necessarily acquisition cost is for the entire rights. Let me say exploration cost in this case. The exploration cost is such that I've incurred $20 million here. And I've incurred $65 million here, which means my total expenditure stood at 85 million. The question then is, using successful effort method, how much am I going to move from exploration and evaluation assets under IFRS 6 to intangible assets and PPE under IS 38 and IS 16 respectively? That's the question. Now, we are saying that under successful effort method, the portion that is not successful, which is this, should be expensed. Immediately before development commences, because it failed, it was unsuccessful. Why this portion should be reclassified? You know, it's already capitalized, but should be reclassified to IAS 38 if it meets the definition of intangible assets, and IAS 16 if it meets the definition of property, plant, and equipment, which is a tangible aspect. That's what successful export says. But in contrast, The full cost method is saying that, no, these 20 million attributable to unsuccessful field are integral to this 65 million that are successful, because this is a venture that is highly uncertain, where you cannot with any degree of precision to determine what it is. Therefore, you need to exploit different parts in order to be able to narrow it down to where you can get oil. And on that basis, these 20 million relating to these two exploratory wells are integral parts of the other 5 exploratory wells. And therefore, they should be considered holistically, which means the $20 million attributable to the unsuccessful exploratory well should be combined alongside $65 million attributable to successful exploratory wells. Then the sum of $85 million will be reclassified as deemed appropriate to IAS 38 if it's intangible, and IAS 16 for tangibles. Does that make sense now? But this discussion I just had with respect to successful effort method and full cost method are outside the scope of IFRS 6. Any question? Any question?
No.
Okay, thank you. Now, let's look at what IFRSs applied to again. Can someone read it out for us?
Okay, IFRS 6. I read. Just a minute, sorry. It's not coming up. Okay. Okay, I read now. IFRS 6 requires that mineral resources on initial recognition are measured at cost. Subsequent measurement may be based on either the cost model or the revaluation model. Assets must be assessed for impairment in accordance with IAS 36. Key terminologies. Exploration and evaluation expenditures are expenditures incurred by an entity in connection with the exploration for and evaluation of mineral resources before the technical visibility and commercial viability of extracting the mineral resources are demonstrable. Exploration and evaluation assets are exploration and evaluation expenditures recognized as assets in accordance with the entity's accounting policy. Exploration for and evaluation of mineral resources is the search for mineral resources, including minerals, oil, natural gas, and similar non-regenerative resources after the entity has obtained legal rights to explore in a specific area, as well as the examination of technical feasibility and commercial viability of extracting the mineral resources. IFRS 6 Appendix A.
Thank you very much. Now, you've seen that the following terms are key for understanding exploration and evaluation expenditure, which you now see the expenditure we are talking about. Okay, and this expenditure, as you have seen it here, more or less excludes any form of expenditure in arriving at technical feasibility and commercial viability, which means expenditure that involve developmental phase and commercial or production phase are excluded from E&E expenditure. That's another short form. They call it E&E expenditure. Now, E&E assets, which is exploration and evaluation assets, are exploratory and evaluation expenditure recognized as an asset in accordance with the accounting policy. Because again, not necessarily will all be recognized as assets, because a portion of it might be expense because of materiality and some other things like that, which is triggered by the company's adopted accounting policy. Why, in conclusion, the exploration for and evaluation of mineral resources entails a rigorous search for mineral resources, including minerals, oil, natural gas, and similar non-regenerative resources. The word non-regenerative resources is why we consider mineral resources as a depleting asset or wasting assets, because once you take, it does not replace itself. That's why it has a level or quantum that once you are able to lift from the ground, that quantum, there's nothing left. It becomes a dry ore. You can see now, it means it's not something that, it's not like agricultural activity where the land can more or less increase in its nutrition and reproduce. No. Once the quantity of oil can be proved on the ground, whereby once you lift, what you have lifted cannot be replaced, because it is not regenerative in nature. Okay, and that is that. And one thing there is that it is an activity to getting these mineral resources proud after you have already obtained legal rights, but before moving to level of development and production. Level of development and production is usually triggered by the advanced level of technical feasibility and commercial viability of that. Does that make sense now?
Yes, sir.
Okay, now let's look at it. How do we recognize expenditure incurred with respect to exploration and evaluation of assets? Now, one thing you need to understand is this. Expenditure is recognized as an asset under IFRS 6 between the period of having the legal rights and before the technical feasibility and commercial viability of extracting these mineral resources from the ground. And one thing we need to note is that entity must have necessary technical and financial means to extracting the resources for us to even consider that E&E as an asset, which means if you have E&E expenditure, but the technical feasibility of moving on further or financial capability of going on with that venture is practically not certain or cannot be attained, that E&E expenditure will not necessarily qualify as E&E assets, and in that case, it will be expense. Okay. And that's why you find out that not necessarily all E&E expenditure will culminate to an E&E assets. An entity can choose its own accounting policy as long as it's in line with the requirement of IAS 8. I think I mentioned it earlier. IAS 8 will guide us in management formulation of accounting policies and the consequence of management changes in accounting policy, changes in estimates, and correction of errors. Okay, and it is clear that specifically it must conform with the paragraph 10 of IAS 8. And the paragraph 12 deals with how management can use its judgment in formulating an accounting policy that is relevant and reliable to the financial information that will be presented to the users of financial reports. And after that, management must follow that policy consistently, which means management will not be at a latitude of changing those policies in order to achieve one or two objectives. No, remember, consistency is key to adopting any policy in accounting. Also, expenditure related to development of mineral resources must not be recognized as E&E assets under IAS 6. Okay, but such can be recognized under IAS 38 or any other standard, as the case may be in reference to that. But take note, anything from developmental phase to production phase are totally outside the scope of IFRS 6. E&E are assets that qualify based on the fact that they are E&E expenditure that met minimum criteria. Okay, and that is that. Now, the next step for us is to say that, okay, how do we measure upon initial recognition an E&E assets? The standard is so clear. The model of operandi of measurement will always be at the cost at every point in time. E&E assets will be measured at the cost. And what is the cost? The cost represents the transaction price to which those expenditures were incurred. Nothing more. They will not be carried at a depreciated cost, neither will they be carried at fair value or any other value other than at cost. Now, the standard makes us to understand that there are various examples of expenditure that might be incurred upon initial measurement of E&E assets. Okay, and those are related to acquisition costs and exploration costs, as I've explained. Now, from this example now, I want you to tell me, out of these 6 examples, group them into acquisition costs and into exploration costs. Now, remember, when we started, I said IFRS 6 deals with acquisition costs. This with acquisition costs and this with exploration costs. Acquisition costs deals with obtaining legal rights, and exploration costs are incidental costs such as geophysical survey, seismic survey, exploratory wells, and some other incidental costs that you incur prior to obtaining the developmental phase and production phase of a mineral resource. Okay, in that light, with that little understanding, can you tell me, acquisition of right to explore, what are you going to classify it as? I want to hear your voices.
That should be acquisition cost.
Acquisition cost. Okay. Topographical, geological, geochemical, and geophysical studies.
Exploration costs.
Exploration costs. Exploratory drilling.
Exploration costs. Exploration costs.
Exploration costs.
Exploration costs. Sampling exploration costs.
Sampling exploration.
Yeah.
Activity in relation to evaluating the technical feasibility and commercial viability of extracting mineral resources.
That should
be exploration cost as well.
Exploration cost. Thank you very much. That means you are following. Okay, an entity should also recognize cost of any obligation for removal of restoration in line with IS 37. Okay, by the time we discuss IS 37, you understand that example of cost in doing this are costs that you have to incur in restoring the land to its initial state. And such costs may include making provision for abandonment, if any, and abandonment costs, restoration costs, and C, asset retirement costs. These are just nomenclature that is interchange, but all of them relates to cost of either removing, restoring, or retiring an asset. And this will be recognized in line with IAS 37 in making a best estimate towards a future cost that is onerous on you as an entity to incur in relation to extraction of mineral resources from the ground. Any question at this point?
No questions.
No question for now.
Okay. Now, I'll give you an exercise. Let's look at this exercise. And I want us to deliberate on it. Can somebody read the question? And let us try and provide a solution to it.
Example, cost. Gold Diggers Co. is a mining company currently exploring and evaluating the PC gold from the desert of South Australia. It has incurred the following costs in the year ended 20X1. Legal expenses relating to acquisition of land in which exploration is to take place. That's $15,000. Legal expenses relating to acquisition of rights to explore land, $12,000. Exploration drilling costs, $123,000. General administrative overhead allocated to exploration of land in South Australia, $25,000. Costs of extracting gold, $152,000. Which of the above costs may be capitalized as exploration and evaluation assets in accordance with IFRS 6? Okay.
Now, I want you to look at it carefully.
I will say all the costs apart from the last one, which is 52 million, will be capitalized. I think that's where I see it. All the costs apart from the last one, 152 million.
Drilling, that's exploration costs, expenses, that is acquisition cost.
Okay, the first thing I will advise us is this. Can we classify this one by one? Can we classify this one by one and try to understand what the cost may be? Is that okay?
All right. So, double expenses related to acquisition.
Now, let's look at the first one. Legal expense relating to acquisition of land.
Should be expensed.
No, before expense, I'm looking at the category of cost. Having land, acquisition of this land,
Yeah.
acquisition of this land has nothing to do with exploration. Because even if you own that land and there's mineral resources there, you can't explore without having rights from government. Therefore, buying the land has nothing to do with the exploration. And therefore, this land probably
Should be expensed.
no, it is IS16.
Okay, IS16, that's true.
Because you have
IS16.
oil under your land, does that mean you just carry tomorrow and be digging and extract oil? No, it belongs to the state. If you remember when I started to discuss issue of mineral resources. Therefore, this has nothing to do with the
Yes.
cost structure of mineral resource extraction. Legal expense relating to acquisition of rights to explore. See, right what? Explore land. This is an acquisition cost, Abby?
Yes. All right.
Exploratory drilling costs. That is
exploration cost.
exploration. General administrative overhead allocated. This is an apportionment cost that has nothing to do with, and guys, this is like general office administration. So, okay, let us share head office costs to different projects and all sorts. It has nothing to do with the exploration at all. Therefore, we'll come to the implication of it later. Cost of extracting gold. This is what? You know, I told you there are 4 costs: acquisition, exploration, development, and production. Cost of extracting gold is what?
That's the production cost.
Production cost. Now, the question is this. Legal expense will be treated as PPE, therefore, is capitalized. Legal expense relating to acquisition of rights is acquisition cost. Therefore, this is E&E expenditure. Drilling cost is E&E expenditure. General administrative will be expense to profit or what? Loss. Cost of extracting gold is a production cost, which will be matched with the revenue. And therefore, that will be treated appropriately in line with the way you treat your cost of products. Okay, which means in that case, this barely meets the definition of, take note, an intangible assets, IS38. Hence, it should be treated as a direct cost of earning a revenue, which means it will be expense as revenue is recognized. Does it make sense? As revenue is what? Recognized. Okay. Now, let's see the elaborate solution now. Can somebody take it up and see whether it's in tandem with the way I've analyzed it?
Solution. The following costs can be capitalized in accordance with IFRS 6. Legal expenses related to acquisition of right to explore land, exploratory drilling costs. Okay. The following costs cannot be capitalized in accordance with IFRS 6 and should be expensed. General administrative overhead, allocation to exploration of land in South Australia, cost of extracting gold. Okay. Then the following costs cannot be capitalized in accordance with IFRS 6, but can be capitalized in accordance with other standards. Legal expense related to acquisition of land in which exploration is to take place. Okay. Yeah, that's exactly what we've done. Then note 1, general administrative overhead do not relate to the exploration and evaluation of resources and must be expensed. 2, the cost of extracting gold are incurred after the process of exploration and evaluation has ended and are not therefore accounted for in accordance with IFRS 6. They are costs incurred in the ordinary course of a business and will likely be expensed as they are unlikely to qualify as intangible assets under IAS 38. The land is acquired before the process of exploration and evaluation begins, because by definition, the entity cannot be exploring and evaluating resources on land it does not own. The legal expenses related to the acquisition are therefore not accounted for in line with IFRS 6, but are instead capitalized as part of the carrying amount of the land in accordance with IAS 16. Okay.
Does that make sense now?
Yes, it's well treated.
Okay. Okay. Thank you very much. Now let's look at measurement after recognition. Now, subsequent to recognition, initial recognition, remember at recognition it was cost model. Subsequent to initial recognition, we are going to recognize it either at cost model or as evaluation model. Okay, but it's an accounting policy choice, which must be followed consistently. And this cost model and evaluation model is taken after IAS 16 and IAS 38, depending on the nature of the E&E assets, whether it's a tangible or an intangible leg. Okay, and that is that. Okay, but again, one thing that is critical there is that you are going to be subjecting it to an impairment assessment. Okay, an impairment assessment at that point in time. But before then, let's look at reclassification and reclassification. Can somebody read that up? Reclassification.
Classification and reclassification. Exploration and evaluation assets are classified as tangible or intangible according to the nature of the asset acquired. For example, drilling rights would be intangible. Vehicles or drilling rig would be tangible. The classification must be applied consistently. They should no longer be classified as exploration and evaluation assets when the technical visibility and commercial viability of extracting a mineral resource are demonstrable. Any impairment loss on the assets must be recognized before
classification.
before reclassification.
Yeah. Thank you very much. Now take note. Once you have reached developmental phase, which is a phase where there's a highly demonstration of technical feasibility and commercial viability, you must reclassify every of your E&E assets to the appropriate leg. The nature of those costs or assets will determine whether it goes in line with PPE or it goes in line with intangible assets. And peradventure, if there's any evidence of impairment, before you reclass, you must have carried out that impairment assessment in line with IFRS, and such impairment loss will have been written off to your profit or loss, and the carrying amount as revised will be the reclass amount into the appropriate category of assets and liabilities. Now let's talk about impairment. So we've discussed extensively about impairment of assets under IFRS 6. Let's see whether there's a material difference and what are the factors that contribute to an impairment assessment. And now, I want you to assist me in this.
Impairment. Exploration and evaluation assets must be assessed for impairment when facts and circumstances suggest that the carrying amount of an asset may exceed its recoverable amount. Any resulting impairment loss must be measured, presented, and disclosed in accordance with IAS 36. The following factors suggest exploration and evaluation assets should be tested for impairment. A, the period for which the entity has exploration right has expired or is due to explore in the... I'll take it again. The period for which the entity has exploration right has expired or is due to expire in the near future and is not expected to be reviewed. B, substantive expenditure on further exploration in the specific area is not budgeted or planned. Exploration in a specific area has not led to the discovery of commercially viable quantities of mineral resources, and the entity has decided to discontinue activities in this area. D, sufficient data indicates that whilst a development in a specific area may proceed, the carrying value of the exploration and evaluation asset is unlikely to be recovered from successful development and sale. IFRS 6, paragraph 20. For impairment purposes, each cash carry unit or group of units to which an exploration and evaluation asset is allocated must not be larger than a segment as determined by IFRS 8, operating segment. IFRS 6, paragraph 21.
Okay, now everything we've discussed here is not materially different from what we've discussed specifically under IAS 36. Okay, but the only thing is that it takes cognizance of the specific nature of mineral resources. And one of those critical factors that triggers impairment assessment is when your exploratory rights or license will soon expire or has expired and there's no liability of being renewed. Okay, another one is where your expenditure are substantively incurred is such that you continue to incur expenditure in a manner that is not budgeted for or planned, that has now made it onerous that bulk of what you have incurred might not be recoverable by way of economic benefit derivable from your venture or exploration. The third aspect also deals with issues that you have discovered that moving to commercial quantity might not be sufficient to support your further developmental costs. And at that point in time, you need to abandon such a venture and exercise, and it becomes an abandoned project or a discontinued operation or activities. And again, where evidence has shown you that though some areas you continue to develop with generate economic benefit, whilst most other areas may not because of the lack of commercial viability. But at the end of the day, when you look at it holistically, bulk of revenue or economic benefit associated with developmental field that is commercially viable is not sufficient enough to cover the entire cost of your E&E assets, as the case may be. Therefore, all of this signify that there is an impairment, and therefore you need to assess the impairment by trying to estimate your recoverable amount and compare that with your current amount of E&E asset. The excess of your current amount of E&E asset over the recoverable amount of that E&E asset will be more or less recognized as an impairment loss in your profit or loss. And similarly, if there's any valuation surplus earlier created by way of your accounting policy option of a valued amount, such impairment loss will first of all be used to reduce to zero, if any, your evaluation surplus, and any excess above that will be charged to your profit or loss. And also, as we all discussed under IAS 36, there are some assets that are tested for impairment on a cash generating unit basis. And the same system or the same methodology applies, but you must take note, even we have it under IAS 36, that any cash generating unit should not be larger than what will have qualified as a reportable segment or operating segment under IFRS 8, and that is very key for our understanding. In conclusion, what are the disclosure requirements? What are the disclosure requirements? Remember, disclosure requirement entails what information you need to provide, qualitative and quantitative, especially as it's supported within the notes to the financial statement. An entity is required to disclose information that identify and explain the amount recognized in the financial statement as it arose from your E&E development. Let me use the appropriate word, E&E activities regarding mineral resources, which may include E&E expenditure, those expense, and those capitalized and E&E assets. Now, paragraph 23, in compliance with that, also requires us to disclose the following. One, accounting policy you have adopted for your E&E expenditure recognition, including recognition of E&E assets, as the case may be. Also, you are expected to disclose one, the amount of that asset, associated liability, the amount, income and expenses generated as a result of it, if any, your operating and investing cash flow arising from your E&E activities regarding the mineral resource exploration. And finally, paragraph 25 requires an entity that treats exploration and virtual asset as a separate class and make disclosure requirement in line with IAS 16 or IAS 38 in a consent manner that depicts the nature of that asset. Remember, if the nature of the asset is such that you carry out seismic survey, geophysical surveys, and some other things, such costs by nature will have to be shown as a separate class of intangible, while things like providing platform, rig, and some other tangible assets will be classified appropriately as a PPE or as tangible. Okay, but what we are trying to say is that you must be able to more or less provide sufficient information that disaggregate your E&E asset into tangible components and intangible components. You might do that either on the surface of your balance sheet, or you do that within the notes to the financial statements. Any other question? Any other question? As we wrap up the discussion.
No, no question. It's clear, understood.
No question, sir.
Okay, thank you very much for all your participation, and we bring the class to an end. Thank you very much, and God bless you.